All right, back into the financial accounting series. We're up to lesson 5, sales and accounts receivable. So, lessons 1 through 4, we provided the framework of accounting, kind of went through it at a high level. And now, the next several lessons, we start drilling through the income statement and balance sheet. So, we pretty much start at the top. We start on the income statement with sales, and on the balance sheet with it's accounts receivable is usually the second account from the top. There's some accounting lessons would actually include cash at this point in time and do a bank reconciliation. I've decided to skip that one. So we're pretty much starting at the top of the income statement and the top of the balance sheet. All right. So the learning objectives here, we want to identify when to record sales revenue. We want to determine adjustments to sales, credit card discounts, sales discounts, returns and allowances. We want to define accounts receivable and the allowance for bad debts, and then determine bad debt expense using both the percentage of credit sales method and the aging method. All right, let's get into it. Identify when to record sales revenue. Well, when is a sale recorded? Revenue is recorded when it's earned. And just in the first couple lines there, sometimes we say sales, sometimes we say revenue. Just kind of get used to using those interchangeably. I suppose sale, I usually think of that more as a product sale. So I sometimes think of sales revenue as a product sale, and then services revenue is when you're providing services. But just start to think of sales and revenue kind of interchangeably. So revenue is recorded when earned. So goods are delivered, sales revenue, or services are provided, services revenue. Now we talked about that back in lesson 3, but there's a complexity with goods in transit. Goods in transit means they're basically being shipped. So when do you record the revenue? Do you record it, when when it kind of leaves your facilities, or when it arrives at the customer facilities? Certainly if the delivery takes place all within one day, it's not a big deal, but sometimes the delivery takes longer, and we'll talk about that. So what you need to do is understand the shipping terms. These are kind of the legal terms. An FOB shipping point, that means that you will record the sale when the goods have shipped, because FOB is free on board shipping point. So basically, the moment that the goods have shipped, that is when the customer is going to be responsible for loss, responsible for insuring the goods if they want to. The other one is FOB destination. In this one, you're going to record a sale when the goods reach their destination. So the seller in that situation would be responsible to the goods until they get to the customer. And if they were damaged in transit, that would be on the seller, as an example. Then, now this is just something that's negotiated between the parties. Sometimes parties, either want control, so they want to have the title to themselves as long as possible, or sometimes just to avoid the cost of having to insure the goods, in shipment, or kind of have that risk of loss. They might want the other party to do that. So that will be a negotiating point. Now, why is this difference important? Again, not important if it all happens within the day, all right? But if the goods are damaged or lost in transit, it can affect the timing of revenue. And think about it again, not within a day, but maybe the shipment is taking place on a boat, and it's on the ocean over the end of the year. You could imagine something where maybe the goods, leave a company's warehouse, the seller's warehouse, on December 15th. They get loaded onto a truck. I'm in Minnesota, so maybe they get loaded onto a truck in Minnesota, driven to the West Coast, into California, where they spend a few days on a shipping dock before they get loaded on a boat, and now they end up being delivered over to China. They sit on a dock in China for a few days, and then it takes some time to load them on a truck and ultimately get them to the customer's facility in China. Something like that. It can take a while, and so it's important to understand what the terms are here, and the revenue is recognized based on those terms: FOB shipping point or destination. So in that example, if it was FOB shipping point, the revenue would be recognized in 2024, and if it's FOB destination, it would have been 2025. The first review question in this lesson: so under which shipping method would revenue be recorded when goods are received by the customer? So which method do you not record revenue until the goods are received by the customer? What do you think? All right, so we look at these. FOB shipping dock. Okay, that's not a term. Okay, so it's FOB shipping point and not dock. FOB shipping point. This one is incorrect. FOB shipping point would be when they leave the seller's warehouse. FBO destination. That's an intentional typo. All right, so it's not FBO destination. It is FOB destination. The company is going to, the selling company is going to retain title to the goods until they show up, at the customer's location. Then the customer will take title to them, and at that point in time, the revenue would be recognized. So let's talk a little bit about adjustments to sales. And there's 3 different types of adjustments that we're going to talk about. The first one is probably the easiest to deal with, and that's just credit cards. So when you think of credit card sales, why does a company accept credit cards? Well, it does it for convenience. All right, a lot of people just don't have cash on them, so credit cards are going to be useful for that regard. And then also you can just get more business. All right, sometimes people will be willing to charge more on a credit card than they would either have cash available or being able to pay in cash. And it's also lower risk that way. Often, in general, if there's going to be fraud associated, with credit, the bank will be on the hook for that fraud or a stolen credit card, as an example, and the seller would not be on the hook. If you're accepting checks and someone wrote you a bad check and they didn't have funds in the account, or they had stolen the check or something like that, then you might never get paid. Businesses do have to pay a fee to the credit card company. I say roughly 3%. So I take PayPal with some of, if I'm selling training services or books or something like that. And PayPal, the fees, they went up for a while, and then they actually just came back down. There must be increased competition that they're getting, which is driving their price down just under 3%. And this will reduce sales revenue. But as I look at it, if I'm actually selling to someone, and I'm offering some training services or something, they can go out to a website of mine and buy the training services. Would I prefer that they give me cash or a check so I get 100% of the revenue? I guess, you know what I mean? I'd like 100%. No, it's not as convenient. I'd have to get it, deposited to the bank, make sure I don't lose it, stuff like that. But at the same time, I'm happy to take credit cards, because I like to say it's better to get 97% than 0%. If you're selling and you don't take credit cards, sometimes if that's all someone has, they'll just, they'll say, "Oh, I'll catch you the next time and I'll bring cash." Next time might never happen. So it's huge to be able to take the credit cards that way. Journal entry. So we have an increase to cash at the time of a sale with a credit card, and then there's also going to be a debit to the credit card discount, which is a contra revenue account, -R, contra revenue, and then we'll credit the sales revenue. Let's go through an example to drive this one home. So let's say a family spends $30 at McDonald's and they pay via credit card, and let's just assume the fees are 3%. What is McDonald's journal entry? All right, well, they don't get the full $30. The bank is going to take 3% of it. So the McDonald's is only going to get $29.10. There's also going to be, and that one shouldn't be indented there, so it should just be right underneath the $29.10. But it's they're going to pay 90% of credit card fees to their bank, and again, they're doing this just to make it convenient on people. And they're McDonald's, so I'm sure they negotiate a better deal than the 3% anyway. And then they're going to credit the sales revenue of $30, but they don't get that whole $30. They only get $29.10. Compute net sales, $30 of gross sales, 90 cents of credit card discounts is $29.10 of net sales. The next one, sales discounts. Of the 3 that we're going to go through today, we're going through 3 adjustments to sales. This, to me, is definitely the toughest one. All right, so the middle one is the toughest one here. So when we talk about selling on account, we don't actually mean selling via credit card. Because if you are a seller and you sell with a credit card, that's not on account. The bank will pay you pretty much instantly if you want. Selling on account is when you are telling the other person, "Hey, you can have a certain amount of days to pay," right? Maybe you can have 30 days to pay. And at that point in time, they still might pay via credit card, and then you would have those credit card fees, or they might pay via cash or check or Venmo or whatever. So why would you not make someone pay right away? Well, maybe they don't have the money right now, and you actually would increase sales that way. I was just, and it can help grow your business along with the customer. I was just talking to a friend last night. He's my age. I'm 51. He's a little bit younger than me, but back in college, he ran a landscaping business. He and a buddy did. They did not have any money. They just started this like as broke college students, and they went and they needed to purchase like product, flowers and stuff like that. They went to the first flower shop in their small hometown, and they say, "Hey, can we get this on credit? We don't have any money, but we need to get this stuff in order to plant it, then have a customer pay us." And the first place said, "Nope, I've been burned too many times. I'm not going to do it." They went to the second place, and the person trusted them and sold to them on credit, and they paid that person back in 30 days. And then they continued on that business for 3 years, and they gave that flower company a lot of business over the next 3 years because they were willing to extend credit to them. Now, the risk of selling on account is maybe someone pays you late or they don't pay it at all, right? I mean, that was the risk of the flower shop selling to my buddy on credit. But they took the risk and it paid off because they had a great relationship for 3 years. Some companies offer discounts for early payment. Why? That might entice the customers to purchase more, and then also to pay more quickly so that you might get your cash back quickly. And it also might entice them to pay at all. All right. So if you can give someone a discount for paying quickly, then they might be like, well, I better make sure I make that payment so I get the discount. Your customer might say, and make sure that they're going to pay it all. Right. So you'd be willing to sacrifice a little bit if you're going to get paid quickly to make sure you get paid at all. All right, sales discount. So we need to understand credit terms. So a standard credit term might be N30. And what that means is payment is due within 30 days, and there's no sales discount at that point in time. But let's take a look at another one, like 210N30. The 2 is the discount. The customer would get a 2% discount if they make a payment within 10 days. Otherwise, the N is for the net amount is due within 30 days. So if they pay by day 10, they get a 2% discount. They pay on 11, they don't get any discount. They pay on day 30, they don't get any discount. They pay on day 31, and depending upon the relationship between the seller, and the customer, interest could be charged. There could be late payment fees that way. That would just be how they discussed and negotiated it together. Now, the journal entry was the initial sale is made, and there's no discount is assumed. So at the time that you make the sale, you just debit accounts receivable and you credit sales revenue. You don't debit cash up front because you didn't get paid. You sell an account. So this is where you're debiting accounts receivable. Now, we should emphasize, and we talked about this in lesson 3, some companies sell on account and don't give sales discounts. Other companies sell on account and give sales discounts. Regardless, the same journal entry is made up front. Now, if payment is made, if it is made on time within the discount period, then it's going to be debit of cash and a debit to sales revenue for the amount of the discount that they earned, and then credit to accounts receivable. If they don't pay in time, that middle part, the sales discount, would go away. So let's take an example here. General Mills sells $5,000 of their cereal to a local grocery store on account. The local grocery store, asks for credit so that they can basically sell the cereal to their customers at a markup and have the cash to pay General Mills. So what is the journal entry when the goods are sold? Well, General Mills is going to debit accounts receivable and credit sales revenue, each for $5,000. Now they also, and I should emphasize in this chapter in lesson 5 here, we are focused on the revenue side of things. So certainly General Mills would also debit cost of goods sold and credit inventory on that day, but we are focused on the revenue side, really what's going on here. So we're not focused on the cost of goods sold side. So what is the journal entry if the grocer pays within 10 days? Well, then they get a discount. They get a 1% discount on the $5,000, which is $50. So they would only pay $4,950. General Mills would record a contra revenue sales discount for $50, and then their entire accounts receivable would be gone of $5,000. Net sales would be the $5,000 minus the $50 is $4,950. Now, a lot of people, if they mess that one up, would maybe that journal entry would have credited accounts receivable for $4,950 as an example. Maybe they just would have debited cash for $4,950, credited accounts receivable for $4,950, and forgot about the sales discount. Maybe like forgot to account for it separately. Now, the problem of that is if you only credit accounts receivable for $4,950 in the second entry, it's going to look like you still got a balance of $50 in account receivable because you started with $5,000. If you only credit it for $4,950, which would be an error, you'd think you got a $50 balance. You'd send the customer a bill, and the customer would get ticked off because they'd say, "Hey, we paid you in time. We don't owe you $50." All right, the third adjustment here, returns and allowances. Well, sometimes customers return goods that aren't needed. Certain industries, retail, this can happen a lot. Certain amount of hardware where people are buying extra, auto parts where they're buying extra, and then they're maybe returning certain things that way. Now, what is the journal entry when the return is made? We are not going to debit just a simple sales revenue and then credit cash. We're going to debit sales returns and allowances, which is a contra revenue. Now, the biggest thing for this is also a contra revenue. So net revenues, and we'll see that on the next example, but net revenues will be the same, whether or not you debit revenue right here or debit sales returns. Net revenues are going to be the same at the end of the day, but a company wants to track what its sales returns are, because if sales returns are getting like abnormally higher, as an example, that might be a sign that the product isn't as good. So the company wants to track that separately. On the income statement, they would usually report net revenues, so they would not break out for investors and creditors the amount of returns. They could in a footnote if they wanted to. So the example here, CVS sells products of $50 to a customer for cash. A few days later, the customer returns $20 of the products. What are the journal entries? Well, the initial sale, they're going to debit cash and credit sales revenue, each of those for $50. And then when a $20 return happens, we don't just debit sales revenue, we instead debit sales returns. All right, so just we can track the amount of the return separately, and then we credit the cash, each of those for the $20. Compute net sales, 50 minus 20 equals $30. So those are the three adjustments to sales: credit card discounts, sales discounts, and sales returns. So review question 2. If a company ships goods using terms 115 and 45, which of these is true? Take a peek through these. See if you can figure out which of these is true. It's not a 1% discount if payment's within 45 days. Payment has to be within 15 days. It's not a 15% discount if payment is in 1 month. All right. Payment would be considered late if not made within 15 days. No, it wouldn't be late, but you wouldn't get a discount. You'd have up until 45 days before payment would be considered late. Payment would be considered late if it's not made within 45 days. So that's what we would be looking at there. All right, define accounts receivable and allowance for bad debts. Now this one is so it's kind of like two different things. We talked about sales, and now we're going to talk about account receivables and bad debts. So accounts receivable, when a company sells goods and allows the customers to pay later, this is called accounts receivable, right? Accounts receivable are current assets. They're usually the next one on the balance sheet right after cash. Sometimes there's like a short-term investment account, but the balance sheet is in the order of liquidity, and generally accounts receivable are going to get paid back, on average, probably within 30 days. So it's going to be pretty quick. They differ from notes receivable. People will mess these up in their early days of thinking about accounting. They can't figure out what accounts receivable and notes receivable, like the difference of them are. Accounts receivable is, I usually just say that you are selling on credit in the ordinary course of your business. It happens a lot. You're selling goods, you're selling services, people are paying you later. Notes receivable is you're oftentimes loaning money to someone and they're going to repay you on a set schedule with interest. All right. Accounts receivables, they're going to pay as quick as they can, oftentimes without interest. Hopefully that helps a little bit. And within 30 days, notes receivable are loans. I guess I talked about it before I went to the bullet points. And notes receivable can be either current assets or long-term assets. Account receivable are always going to, I'm pretty sure they're always going to be current assets because you're going to expect to get paid usually within a month or two at the latest, and definitely within a year. All right, allowance for doubtful accounts. Do all customers always pay their debts? Well, the answer is no, right? Now, you don't know which of them aren't going to pay their debts when you sell to them on credit. Certainly, if you did, you would not sell to them on credit, all right? So, but you don't know which. So you just make the sales, and you hope that the vast majority of them are going to pay their debts. But the concept of a bad debt is a cost of doing business if you're going to sell on credit. Now, using the direct method, a company would make the following entry when writing off an account. It would debit bad debt expense, and it would credit account receivable. This one would then happen in the year after the sale was made, so the expense would not be matched to revenue. So this method is generally not used, and instead companies will use the indirect method, which means they don't wait until they know which account is uncollectible to record some bad debts, but they rather estimate it. All right, so we might say that they reserve part of their accounts receivable based on how much they don't think they are going to collect. And in doing so, we are going to create two new accounts, the allowance for doubtful accounts and the bad debt expense. So the example, let's say a company has 100 of accounts receivable and estimates that $10 will not be collected. What is the journal entry? $10 of bad debt expense, and the credit is to allowance for doubtful accounts, which is a contra asset of $10. The balance sheet impact, they would show accounts receivable of $100 less the allowance for doubtful accounts. It's a contra asset right after accounts receivable of $10, net accounts receivable of $90. And normally on a company's balance sheet, they don't break this out, but they do say accounts receivable net. They sometimes break it out, I guess, but even if they don't, they'll say accounts receivable net, and that implies net of the allowance for doubtful accounts. So that's the balance sheet. The income statement would just show the bad debts of $10. Now the journal entry, when the company writes off the $10, they are going to do the debit to the allowance for doubtful accounts and credit for accounts receivable. So if they figure this out perfectly, the allowance for doubtful accounts, we credited it for $10 and then we debited it for 10. It's a temporary account which goes away. So it kind of nets itself out, and then at the end of the day, we just have bad debt expense of 10 and accounts receivable were reduced of 10. You usually don't estimate it perfectly, right? You don't know exactly who's not going to pay you. You would never sell to them in the first place. So what let's do the review question, and then we'll talk about how we get into estimating the bad debts. We just told you in the previous slide there was an estimate of bad debts, but we got to talk to you about how we estimate that. So when a company writes off a bad debt using the indirect method, the proper journal entry would be what? What do we debit? What do we credit? Go ahead and check that out. All right. If you put the first one, that's incorrect because bad debt expense is not recorded at the time of a write-off. All right. Again, C is not correct because the bad debt expense is not recorded at the time of a write-off. It's estimated instead. D is incorrect. Bad debt expense not recorded at the time of a write-off. What you do is you debit the allowance for doubtful accounts and you credit accounts receivable at the time of the write-off. The bad debt expense would have already been recorded, usually in a previous period, by estimating the amount of the bad debts. All right. Determine the bad debt expense. How do they estimate that amount? There's two things. We had the example where we said they estimate bad debts of $10. How do they do that? Well, they need to make that estimate, and they're either going to use the percentage of credit sales method or the aging of accounts receivable method. It is GAAP to use one of these methods, but you get to choose. You could choose the one that the company prefers. The theory is that they would do the one that would best reflect their actual bad debts. All right, the percent of credit sales method, this is the easy one. So when you see it, it should be easy. They're going to estimate bad debt expense as a percentage of sales. Start with credit sales, and then just multiply it by a given percentage. And that given percentage should be how much of our sales do we normally not collect. Historical average is usually a good starting point. So the credit sales are $1,000. If we historically haven't collected 2%, then we would say that the bad debt expense would be $20. $1,000 times the 2%. We debit bad debt expense for 20 and credit the allowance for doubtful accounts for 20. We're done at that point in time. Okay? The expense goes on the income statement. The allowance goes as a contra asset on the balance sheet. We're done until we estimate it next period. There's no other steps that we need to do as far as this estimate is concerned. The aging is more difficult. It's frankly a little bit more interesting to think about it and analyze it, and it could be more accurate as a result, but it is certainly more difficult. So what we're trying to do here is not estimate the amount of the sales that we're never going to collect, but estimate the amount of the receivables which we aren't going to collect. And we do that through a process called aging the receivables to say how long have they been outstanding for, estimate the uncollectible amount by how long they've been outstanding for, and then make a journal entry so that the balance in the allowance account is what we computed it to be. That was a mouthful, so we're going to have to go through it. So step one, age. Let's say a company has an accounts receivable balance of $1,000, and that $1,000, there's 700 of it is current, meaning that that's not past due. 150 is up to 30 days past due. So, $100 is 31 to 60 days past due. $40 is 61 to 90 days past due, and $10 is 91 days or more past due. So that's how their total accounts receivable breaks down. Now, as you might expect, the top line here is what you just saw on the previous slide. But the more past due that the receivable is, the less likely that we're going to collect. It's just, there's a reason they're not paying for us, right? There's something wrong with the relationship. They're out of cash. Who knows what it is? But there's a reason they're not paying for us, and it's going to get less likely to collect. So what we do is we estimate the amount of we take the amount of the account receivable in that age, multiply it by the percentage, and that's the amount uncollectible in that age. So 700 of the receivables which are current and not past due yet, we're going to say 1% is uncollectible. $7 of those are uncollectible. Compare that to the stuff that's 91 days past due. That $10, 20% is uncollectible, so $2 of that is uncollectible. So in the total, we would say that we have $1,000 of receivables and $30 is uncollectible. Now, what that uncollectible is that is a balance sheet amount that we've computed, okay? So what we need to do is say, well, $30 should be in our allowance account. What is in our allowance account? Now I'm just kind of throwing another fact at you. Let's just say that we looked in there and the amount in the allowance account was $22 before you did the aging. We need an extra $8. We need to get to $30. There's $22 in the account, so we need another $8 in that account. The adjusting entry, the credit for me is usually a little bit easier to think of here, the allowance for doubtful accounts of $8, and then the debit is the bad debt expense. The most common wrong answer here is that someone would just debit bad debt expense for $30, credit the allowance account for $30. The percentage of credit sales, you're looking at sales. Here you're looking at a balance sheet amount that isn't going away. It isn't being reset. It isn't being closed out every period. So we're computing how much of that balance sheet amount of accounts receivable is uncollectible. How much do we think is uncollectible? Compare it to what's already in that allowance account, and that's the amount of our adjustment. The review question right here, review question number 4. says if a company has sales of 10 grand for the current year and half are on credit, if it estimates it won't collect 3% of credit sales and writes off $100 of receivables, calculate the bad debt expense. Well, whenever you're seeing the percentage of credit sales, that's really easy. You don't have to worry about what's in the allowance for uncollectible accounts. You don't have to worry about write-offs or anything like that. You just say, what are my sales on credit? And then multiply them by the percentage. So the answer is not $50. All right. So that one is not going to be the answer. The write-off of the receivables doesn't impact bad debt expense. It's not $200. Only half of the sales are on credit, and bad debt expense is not going to be impacted by the write-off. The answer is not $300. Some of you might have said, okay, 10 grand times 3%, that's $300. But what it says is only half are on credit. So the other half, there's no risk. So this is the percent of credit sales, not the percentage of sales method. It's the percentage of credit sales. So we take the 10 grand of total sales, divide it by 2. We sold 5 grand on credit times the 3% uncollectible is $150. We ignore that write-off of the receivables. We ignore what's in the account receivable. We ignore what's in the uncollectible accounts if there was something. All we do is percent credit sales multiplied by a percentage. If it had been the aging approach, then we would have had to do the more complex analysis. Well, the key takeaways, hopefully you learned about adjustments for sales, the credit card discounts, just a quick discount to sales. Sales discounts apply if you get paid within the period. And when items are returned, you're going to debit that sales returns account. Estimate the bad debt each period using one of two approaches. The percent of credit sales, it's easy. What are credit sales times a percentage? Aging is more difficult. You need to look at accounts receivable by how long they've been outstanding for, apply a percentage of uncollectability to them, total that up, and then compare it to what's in that, what's already in that uncollectible account in order to make your adjustment. That's what we got today. We'll see you next time for Lesson 6.